optimism over an ETF launch sent investors piling into the coin. Now, the buzz began when senior Bloomberg intelligence analyst Eric Balchunas noted in a post on X that BlackRock's Bitcoin ETF has been listed by the Depository Trust and Clearing Corporation, or DTCC, with the ticker IBTC. Now, this follows a filing to the SEC last week that showed a seed capital investor planning to buy shares of BlackRock's Bitcoin ETF this month. But can investors sustain this optimism and this rally? Joining us now is Octavio Marenzi, Opimas CEO. Good to have you on the show here. So, not to take too much of the wind out of the sails of the optimism that we're seeing here, but give us a reality check as to how well-founded this optimism, at least for the token Bitcoin, is, just based on this news of the stronger potential of a spot Bitcoin ETF.
Well, it does feel like they're clasping at straws a bit in terms of pushing the price up. I mean, there are other Bitcoin ETFs out there. They're basically in the futures market as opposed to being in the spot market. But really, in terms of price exposure to Bitcoin, you can get that. And there have been ETFs out there for a few years now that have allowed retail investors to do that, and institutional investors as well, for that matter. They really haven't attracted that much attention. Some of them have around $1 billion in assets. Most of them have sort of in the tens of millions that haven't fared terribly well. So I think this idea that this new ETF, spot ETF, is going to draw a whole bunch of new investors into the Bitcoin market and drive up the prices, generate enough investment volume that's going to push up the price, I think are likely to be disappointed. It just is not that big a market for that kind of investor. Most of the people who want to get an exposure to Bitcoin are quite happy to do it directly and buy Bitcoin directly through an exchange or through a separate account to do that. So I think there might be a bit of disappointment. We might be getting a bit ahead of ourselves in terms of the boost that this is going to give to the market.
That's true. We heard similar sentiments from Nicholas Panicirtsolu of JP Morgan saying any approval won't be transformational for the sector, citing the same examples as we've seen with Canada, with Brazil, other countries in Europe that have launched this, haven't seen these tremendous inflows. So then what's the driver here? Because it's the difference between getting exposure to Bitcoin's movements versus to the token itself. What is the institutional interest here then?
Well, I suppose it is the difference is really that it's BlackRock behind it. So it's the world's largest asset manager. They're pushing forward a new Bitcoin ETF, basically. And I think there's some sentiment that this is going to attract it and basically make Bitcoin investments sort of legitimate for institutional investors as well. And that's something we've really been waiting for years. I mean, there have been some hedge funds and some investors, institutional investors playing the space, but by and large, most sort of long-only funds, most of very large institutional investors have sat by the sidelines. And we're always sort of expecting them to jump in now. And maybe that's really what they're thinking, that not only is it people going to invest directly in this ETF, but rather what they're going to do is say, okay, now it's finally a legitimate investable asset class. I can do it. BlackRock's in there. Or pension funds and people like that can now come in larger numbers. And I think that's the expectation there. But we've seen this many, many times, this kind of false start many, many times over the course of the past few years, where we sort of think the institutional investor stampede is just around the corner, it's just over the horizon, and it's about to arrive. And I fear that's once again what we're seeing here, that there's a sense that now the institutional investors are going to come. Now that BlackRock has got this ETF up and running, we're going to see all these pension funds and institutional investors come in and storm the market and drive the price up. But I think that's led to disappointment a few times in a row now.
Indeed, and we know that crypto enthusiasts are always looking for that next catalyst that's going to drive it. So any bit of positive news, including the SEC's losing its lawsuit against Grayscale, adding to that momentum, but tempering expectations here. I also want to talk to you about what we've been seeing with the bond action as well, because back in the day, Bitcoin, people considered it some kind of safe haven, especially when there was a fluctuation with what was happening with interest rates. But in terms of the 10-year, do you think it's peaked, the yield on the 10-year?
I do not think it's peaked. I've heard a lot of people say this. We've hit 5%, and that's somehow a magical level, and it can't rise beyond 5%. It's too awful to even contemplate beyond a 5% return on the 10-year. And therefore, you should start to pile in. You should start to pile into 10 years, 20-year, 30-year treasuries and get some real exposure to interest rates because they're going to come down. And bear in mind, of course, as interest rates go down, the value of bonds go up. So if that's correct, that assumption, well, that should be a very, very good investment indeed. And the further out you are in terms of duration, if you can take it at the 30-year end of the yield curve, well, then fantastic. you have a big exposure to interest rates. If they do come down, and that hypothesis is correct, you stand to make quite a pretty penny there. But I fear they might be disappointed. It's not a trade that I'm rushing into making right now myself. I'm basically saying it looks to me like there still might be some upward momentum on the yield curve, on the interest rates, and the Fed might have its hand forced. Inflation is being much more stickier than we'd anticipated, I think, and it's going to look like it's going to carry on this. So the Fed might have to carry increasing interest rates before it starts to decline. And I did go back and look at some of these people who've been predicting that the Fed would now start to cut interest rates. Some of them have been saying this for well over a year, have been very, very disappointed with the returns that they've generated there. So I fear we're going to see more of the same. The interest rates are going to carry on basically percolating upwards, and that's going to put downward pressure on these bond prices. I can't say from my perspective right now it's a good trade, but it might fit into someone's portfolio depending on your position, but I would keep away from it for the time being.
So with that in mind then, you're saying that now is not the time to get into long-dated bonds. At what point would you think that would change? At what point, what signals would you be looking for?
Well, the signal, I think, more than anything, is going to be that inflation is under control and that the economy sort of seems to need some sort of stimulus and boost. And that is going to lead the Fed to start to cut interest rates again. And that's really what I'd be looking for. A situation where it looks like the Fed is about to embark on a sustained cutting of the interest rates. And that will then generate very, very good returns. But for the time being, I think the very short end of the Treasury, of the yield curve, is looking very good indeed. So you can get 5.5%. On the very short end, so the 1 to 6 month end of the yield curve, for basically taking no risk at all. And at that end of the yield curve, you have basically no exposure to interest rates. That if whether interest rates go up or down, it's not really going to affect your principal investment there. Unlike at the very long end, where it's very sensitive to changes in interest rates. So I think the short end of the yield curve is the place to be right now. Park your money there. You can get 5.5% there. In fact, the yield is higher than it is on the 30-year Treasury. So I think that looks like a really good investment. I can't remember a time when you could get basically 5.5% return for doing nothing and taking no risk. So I think that's a really nice place to be right now.